Federal Reserve issued its first statement on interest rates since Donald Trump became president. And while the central bank decided it was not the right time to hike, it also didn't offer many clues for investors as to what may come next. So Steve Leisman did some digging.
The Federal Reserve kept rates unchanged at its January meeting and kept the markets guessing about when the next rate hike will come. The average Fed official is forecasting 3 hikes this year, and markets look for June to be the most likely next month. And the chance of a quarter-point hike fell in March after the statement from around 29% before the meeting to 22% afterwards. In its unanimous decision, the Fed retained most of the language about the economy in its January statement from what it used in December. It said the economy is expanding at a moderate pace, and the labor market has continued to strengthen. It sees gradual rate increases in the months ahead, and it will continue to maintain the size of its $4.5 trillion balance sheet, which swelled up after the financial crisis in an effort to stimulate growth. But the Fed did express more confidence in the inflation outlook. It no longer says inflation is the result of temporary factors like higher energy prices. And in a typical nuance meant to be noticed by markets, it said that inflation will rise to its 2% target rather than it's expected to rise. The Fed also noted more business and consumer confidence, which has shot up in the wake of the election of President Donald Trump. Yet the Fed has not changed its economic outlook since the election, even while markets have soared as it awaits specifics of Trump's policies and weighs possible trade-offs between good and bad policies. All this raises the stakes for Fed Chair Janet Yellen's testimony to Congress, which starts on Valentine's Day, but is not expected with the Republican Congress to be much of a love fest. For Nightly Business Report, I'm Steve Leisman in Washington.